Hi and welcome to this special episode on silver. We will talk about what drives its price, how is the market structure, and what instruments you can use to trade it. So tune in, we will talk about all you need to know about the white metal. But before we do, note that this episode is for educational purposes only and it is not financial or investment advice.
This show is brought to you by Swissquote.
So let's get this straight right away. Silver is grouped with gold under the label of precious metals, but that label can sometimes be misleading. Because unlike gold, silver is not a safe haven asset. It doesn't reliably protect investors in times of market stress and market sell-offs, and it doesn't benefit from a negative correlation with the risky assets as gold does. On the contrary, it often behaves more like a cyclical asset than a defensive one. So I thought it was important to say that right away, right from the beginning. Silver is a precious metal, yes, but it is not a safe haven. It's rather a cyclical metal. And the reason for that is quite simple, is because it is an industrial commodity. Roughly half of global silver demand comes from industrial uses. Silver is used in electronics, solar panels, electric vehicles, medical equipment, and chemical processes, and so. And that industrial identity makes silver highly sensitive to the economic cycles. That means that when growth slows, industrial demand weakens and silver prices tend to suffer, and that even if financial markets are under stress, because again, it is not meant to protect you against market sell-offs. And then when growth accelerates, industrial demand rises and silver prices tend to rise as well. So that means that macroeconomic environment plays an important role in silver's performance, hence interest rate decisions. And economic data are very important factors to watch and to understand to explain why silver prices move the way they do. But not only, and I will come to the complexity of the silver market's dynamics very shortly, but before we move on, it's also important to say that on top of the economic data, and as it is the case for gold and other metals and other commodities as well, US dollar also has an important impact on silver prices. The cheaper the US dollar, the higher the demand outside the US, the higher the price of silver. And you can also say, if you prefer, the cheaper the US dollar, the cheaper the commodities complex for those who are outside the United States, like emerging markets, for example, which have a strong demand. The stronger the growth expectations globally, the stronger the demand for silver and other metals. And I say other metals because you will see that this is important as well, and I will come shortly to that. But to finish this part, the cheaper the US dollar, the higher the global demand and the higher the silver prices. So global macroeconomic conditions, economic data, growth expectations, growth, interest rates, and the US dollar strength. Everything that has to do with growth and growth expectations matter for silver prices. Now let's dive into the dynamics of this market, looking at the supply side first and come to why the demand for other metals is so important for silver. As all commodities, silver is structurally constrained. The largest silver producing countries include Mexico, China, Peru, Chile, and Australia. Production is concentrated, but it is not cartelized. There is no equivalent of OPEC, for example, in the silver market. So production depends on demand, but not only demand for silver. In fact, the relationship between silver's demand and supply is not that straightforward. So listen, this is interesting. Only around a quarter, yes, a quarter of global silver production comes from primary silver mines. The majority is produced as a byproduct of mining other metals, mainly copper, lead, zinc, or gold. So that means that silver supply is largely driven by the economics of base metals and not by only silver prices or the silver demand itself. And this ultimately means that even if silver rallies sharply, for example, miners don't suddenly produce more silver unless copper or zinc production also increases. And this makes silver supply relatively inelastic, but also somehow detached from the silver specific fundamentals. And this explains why we could sometimes see an unclear cause and effect relationship in silver demand and supply and its prices. On the demand side, industrial buyers dominate this market. Electronics manufacturers, solar panel producers, and the automotive sector are key consumers, obviously. And in the recent years, silver's role in the energy transition has become increasingly important. Solar panels in particular require silver silver for their conductive properties, and that has boosted the metal's strategic relevance, meaning that silver demand has become more structurally linked to long-term themes like decarbonization and electrification, for example. And China, for example, decided to add silver among its strategic metals and limit its exports. And to add more complexity to the mix, the latest loss of appetite for the US dollar globally also triggered a significant rush toward precious metals and hard commodities, and silver grandly benefited from that move. It rose actually more than gold did in 2025, a year marked by a severe sell-off in the US dollar. But how much more? Now, one popular way to frame silver is through the gold-silver ratio, also called the Mint ratio. This ratio measures how many ounces of silver are needed to buy 1 ounce of gold. And historically speaking, this ratio has been mostly ranged between 60 and 80 levels. Obviously, there have been periods when it swung wildly up, rising above 100 level, for example, during periods of economic stress, or significantly below the 60 level, for example, as it has been the case in 2025 rally, when silver surged faster than gold due to a combination of strong industrial demand, expectations of higher inflationary pressures globally, and for being a cheaper alternative to gold for investors looking to diversify away from the US dollar and hedge against geopolitical and inflation risk. Now, if history is any guidance, you would expect this Mint ratio to return to that 60 to 80 range. For that to happen, either silver should cheapen more than gold or gold should rally more than silver. But wait, note that historical data is not an exact science, and the fact that silver's role in major global themes has changed could eventually lead to a fresh range of rally against gold. Time will tell. Now, so far we talked about silver market, supply, demand, and its price relative to gold. So it's time to talk about the market structure here. Silver is a commodity, and as all commodities, its market structure is very important for those who are building exposure to the white metal. Silver futures are traded on many markets around the world, and they often oscillate between contango and backwardation. Contango is when future prices are higher than spot prices, remember, and is common during periods of ample supply and weak demand. Backwardation, on the other hand, is when today's prices are higher than tomorrow's prices and typically emerge when physical silver is tight, or immediate delivery is valued more highly, or today's demand is high for any reason simply. This is the case at the time I'm talking here, beginning of 2026, but it is not always true. And because silver market could be in contango or in backwardation in different periods, watching shifts in this market structure and knowing where exactly the market stands at is very important to enter a successful trade here. In a backwardated market, for example, price gains can be amplified as rolling futures generates a positive roll yield, but the opposite would be true in a contango market. So it's very important to know the market structure when you are trading silver futures. And as for trading silver, investors have several options. Futures, as I said, provide leverage and flexibility to investors, but also requires understanding of market structure and price curve. ETFs, on the other hand, offer easier access and track spot prices closely, but could be quite volatile, as silver prices are volatile themselves. Then there are silver mining companies that could be a way to build exposure to silver. Their prices tend to rise more than the underlying silver's price, for example, in times of market rallies. But it's not all rosy there, because these mining companies are subject to political, operational, and executional risk, and also broader equity market sentiment and risks as well. So it's very important to diversify these risks away. And one way to diversify these idiosyncratic risks for companies is to opt for metals and mining stocks ETFs, for example, and trade the whole theme instead of trading one single metal or one single company. So if we summarize, silver is not gold, it doesn't behave like a safe haven, and it shouldn't be treated as one, but it is sure a precious metal. It is also cyclical, strategic, industrially driven metal. It is volatile, it is fascinating, and it's deeply tied to the health of the global economy. So it could be a very exciting and interesting addition to a well-diversified investment portfolio, but not as a safe haven asset, and certainly not in the same category than gold. So this is all all for this special focus on silver. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this educative episode on the white metal has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again very soon and until then, goodbye.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.